What is exclusion in insurance? Exclusions are specific conditions or situations explicitly not covered under an insurance policy. They help insurers define the boundaries of coverage and manage risk exposure. So, in short, the conditions in which the claim amount would not be paid to the policyholder. Let's take an example to understand it better. So, there are health policies which exclude coverage for pre-existing diseases during the initial policy years. So these would be the exclusions for the health policies. And why it is important is basically this protect insurers from adverse selection while giving policyholders time to demonstrate health stability before full coverage applies. So exclusions help insurers clearly define risk boundaries and avoid ambiguity during claims. Difference between sum assured versus sum insured. In sum assured, will get the fixed amount that has been decided. There is only one amount that the insurance company would pay to the policyholder, and complete amount would be given to them. Sum insured is basically we can get the amount that have been decided or less than that. So sum assured is generally for life insurance. Will get the full payment in the case of casualty such as death. Sum insured is basically for health insurance where we can get the amount that has been decided. So let's suppose the sum insured in that scenario is 5 lakh rupees. So we can get either 2 lakh, 3 lakh or 5 lakh rupees. If the spend is 2 lakh for that particular disease or anything like that, so then we'll get that 2 lakh rupees. If the amount is greater than that, then we'll get the amount that has been decided. So let's understand it by an example. Discussing about the life insurance. So policy type is term life. Sum assured is 50 lakhs. So in case of death, we'll get the 50 lakh rupees. Health insurance. Policy type is Mediclaim. Sum insured is 10 lakh rupees. And if suppose the hospital bill is 4 lakh rupees, so we'll get the 4 lakh rupees from the insurance company. So to conclude, sum assured is benefit based while sum insured is indemnity based. What is actuarial science? Actuarial science is the application of statistics, probability theory, and historical data analysis to assess financial risk and calculate insurance premium. So basically, actuaries go through the mortality tables, historical data, and they calculate the premium for that policy. So actuaries are the mathematicians and data scientists of the insurance world. They transform uncertainty into measurable risk using sophisticated mathematical models. So how do they work is basically they will analyze the past data. Then they will calculate the probability. And after that, they will set premium to cover the expected claims while ensuring company profitability and solvency. So not only they calculate premium, actuaries predict future risk as well. They can design the pricing models and they will also ensure profitability for the insurance company. That's why they are the key people for the insurance company. Actual science converts uncertainty into measurable risk using data models, forming the backbone of premium pricing and long term sustainability of insurers.